Welcome to a special edition of Modern Wall Street from the New York Stock Exchange. Today I'm joined by Max Cunningham of the ASX. Max is the Executive GM of Listing and Issuer Services at the Australian Stock Exchange. Happy Friday to you, Max.
Happy Friday, great to be here.
Well, thank you so much for joining me. Now, I understand you're here in New York City. You just wrapped up the ASX Spotlight Issues gathering. So could you tell me about that, and could you tell me about the reception from institutional investors stateside?
Yeah, look, we've got a great market in Australia for sort of small, mid-cap companies, typically companies that are a little bit smaller than you'd see on public capital markets here. So we, in an attempt to boost their liquidity, we run a research program and a conference series that happens in different markets, including New York once a year. And we've had great turnout yesterday with 14 ASX listed companies meeting with US institutional investors.
And when we look at the global stock markets, we're seeing record highs and a lot of funds being poured in.
Yeah.
But when we take a look at the ASX in terms of the market cap of the stock market there, I understand it's approximately $1.5 trillion US dollars right now.
Yes.
So given the conception or misconception that it's just all natural resources or mining companies, you are trying to shift the sector weighting there. So can you tell me about some of the efforts that are underway right now?
Sure. I don't think it's a misconception. It's historically been a really heavy resource commodity, not unlike you'd see in Canada. And at peak of the boom mining cycle, we might have had up to 60% of our market cap in the mining cycle. But what we've got is a compulsory savings scheme in Australia, really like an extended 401k that's seen 9.5% of everybody's pay going into this scheme since 1991. It's getting up to $2 trillion now, expected to get to $5 trillion within the next 10 or so years. And that money is increasingly looking for more and more places to go, and we think diversity is really important. So we've been doing two strategies. One is to attract technology globally. People really want to get exposure to the US dollar in Australia. And then the second thing we've been doing is looking for other sectors, probably most notably in New Zealand, where we've had great success attracting things like food, soft commodities, some of the products that aren't normally available on the ASX. So it's about diversity.
And speaking of technology companies, I do want to focus on that. So when it comes to some of the small caps or even mid caps, I understand that you've become more restrictive in terms of your requirements. So can you tell us how some of the rules have shifted?
Yeah, look, I mean, we have, but I'd call it a tweaking of our rules. I think you've always got to sort of be staying ahead of the market. And when we had companies, I think, that were coming a little bit too prematurely. So all we did was lift the bar incrementally. But I think actually more importantly, we're spending a lot of time with these companies saying, is now the time to come public, looking at alternative funding options. And actually in this massive growth of this sort of 401k type system we've got in Australia, a lot of money is actually going into pre-IPO funding, and that's great for these early stage companies. But the flip side, I'd say, of that is, we'd say we've been funding startups for 100 years. They're just called miners, and one of the New York Stock Exchange Australian companies listed, BHP, started life in Australia as a startup, in 1885.
I think supporting entrepreneurs is very important, so I think you need to take that into account. But when it comes to dual listings, there are several companies that may have gone to the US or other listing exchanges around the world instead of the ASX. So what do you think of dual listing?
Look, I think dual listing, it depends on what you're trying to achieve. We've had a lot of success with dual listings in New Zealand, which has actually boosted some of the liquidity on that home market. Investors are always going to go where liquidity is. I think the risk with dual listing is, do you fragment that liquidity or do you enhance it? Look, I think dual listing, one great example is a company that was a UK insurer, spun off from an Australian insurer called Henderson PLC, merged recently with Janus. It ditched its London listing for NYSE, but has maintained an ASX listing where it has 50% of its liquidity. So it really is a company by company situation, I think.
And Max, happy Friday to you. The opening bell is about to begin.
Yeah,
so
we've
thank
got
you
the
so much
Navy
for
here, so it's a great day to be at NYSE. Yeah.
Thank you so much for joining me, and have a great weekend, Max.
Great. Thanks, Remy.
Thank you.
Cheers.